So chapter number 19, calculation and interpretation of accounting ratios and trends. Now that is a very, very, very important chapter. You people have some knowledge about this topic from your previous ACCA F3, where you calculated your ratio analysis. But in F3, actually, what was important was calculating the numbers. Here, the more important thing is about interpretation. How do you interpret those numbers? And you have to give your analysis. And we know that there are 4 types of ratios which we have. You call them profitability ratios, which is like, ROCE, gross profit ratio, net profit ratio. Then you have got your liquidity ratios like current ratio and, quick ratio, receivable days and payable days and inventory days. 5 ratios usually we do there. Then you have your solvency ratios, which are also sometimes called gearing. And you have debt over equity and interest cover, 2 ratios are there. And then you have your market ratios, which are sometimes called investors ratios. So 4 ratios we discussed there: dividend cover, dividend yield, and price earning ratio and EPS. So in general, calculation of ratios has never been very difficult. Numbers are always easy to find out. What you need to do more here in this chapter is like, the analysis of that situation and the interpretation of those ratios. And this is, I would say that it is one of the most important topics, single topic, which is in F7 exam. So please do not ignore this topic. So define and compute the relevant financial ratios. Explain what aspects of performance specific ratios are intended to assess. Analyze and interpret ratios to give an assessment of an entity's performance and financial position. And then we move to here. So we've got here types of interpretation scenarios, financial ratios, and approach to interpretation questions. Purpose of ratio analysis. It is a tool which is often used to help users understand the results and position of a company using its financial statements. So what you do that numbers, you convert them into percentages, and then percentages you compare over the period. Because numbers are very hard to compare. You cannot make sense out of numbers. Like I said that last year profit is 653 million, this year it is 493 million, you don't understand. But if we say that our net profit ratio last year was 11%, this year it is 12%, you understand that it has improved by 1%. So you convert the numbers into percentages and then compare it. And how do you compare it? Comparison can be done with your own past performance, which is called trend analysis. So trend in trend analysis, you compare your past performance with your current performance, or you can do it, intra-industry, cross-industry analysis, in which you compare your performance with your competitor. In exam, you could be presented with the following types of interpretation scenarios: comparison with an entity's previous period financial statements, or comparison with a similar entity, or comparison with industry benchmark ratios. So industry benchmark ratios mean industry averages. So how good or bad are you doing in relation to industry average? Or probably comparison with a competitor company, A company and B company, or probably comparison of your own company over a period of 2 years or 3 years. So broad category of ratios. So this is the exam question. I'll skip it here and I move here. The broad category of ratios, there are 4 main categories of ratios: profitability ratios, liquidity ratios, gearing ratios, and investor ratios. Gearing ratios are also called solvency ratios. So profitability ratios, if you remember that first one was gross profit. It was very, how to say, simple to calculate. You will just take your gross profit, you divide it with your revenue or your sales multiplied by 100. So you get a gross profit, say 35% or 40%. What you should understand that gross profit ratio when you calculate. So let's suppose that your gross profit ratio comes out to be, say, 40%. So if gross profit ratio is 40%, it means 60% was cost of sales. And if 60% of cost of sale, you should understand that cost of sale is mostly it consists of variable cost. Cost of sale, it moves up and down with relation to your revenue. As revenue goes up, cost of sale goes up. Revenue goes down, cost of sale goes down. So cost of sale major component is variable cost. The gross profit margin measures how well a company is running its core operations. The gross profit percentage should be similar from year to year for the same company. Significant change may be due to change in the sales price, or change in the product mix, or an incorrect inventory valuation, or a change in cost of sales due to efficiency or price movements. So you should remember these 4 factors. If you can spot out or pinpoint one of them happening with the company, you have to speak about it. Then you've got operating profit margin, operating profit before interest and taxes. So this is your PBIT divided by revenue into 100. So this gross profit is only you have subtracted your cost of sales, and rest of the expenses you still have to pay. But in PBIT, you already have paid your admin and fixed costs as well. So the operating profit margin is usually compared to the gross profit margin to determine how well the company is controlling its overhead. How well the company is controlling its overhead. What does that mean? It means that when you've got here your sales, which are 100, your cost of sales, which are, let's suppose, minus 40. So you get your GP, which is 60, and then you have your admin, which is minus 20. And let me put these numbers here so that they come in line. And then you have your distribution expense, say, minus 10. And here I put other expenses, which are again minus 10. So your PBIT is equal to 20. So if your PBIT is 20, so this is actually 20%, and this is actually 60%. So what is happening that from here to here, you are losing 40% because it was 60% and now it is 20%. So it means that 40% you are paying for this area. And you should understand that this part, which is here, is usually fixed cost. And these are your overheads. These are your fixed costs. These are usually your overheads. And I can see here a very huge ratio, 40%. Not a very good idea. So the comparison of GP to NP, that from GP we started with 60% and our NP we ended at 20%. So 40% they go into overheads. So a comparison of this GP ratio and NP ratio is very important. The ratio uses PBIT because it avoids distortion when companies are made between two different companies. So why do we not do it with net profit? Because net profit you already have subtracted taxes and interest. So we want to see it and we want to do it before interest and taxes. Because in different countries there are different interest rates and different tax rates. So comparison will not make much sense. So significant change may be due to the reasons previously stated for the movement in GP. Maybe GP has gone up or gone down, or maybe there is some administration and distribution costs. So you have to consider them as well. Return on capital employed, one of the most important ratios for investor, ROCE. So it is PBIT divided by capital employed. So the formula for here is PBIT. What you should remember in easy wordings, you should remember it is profit before interest and taxes divided by capital employed. And you remember that capital employed is equal to total assets minus current liabilities. This is what you should remember, that total assets minus current liabilities. Or you may also call it like this: capital employed is equal to equity plus non-current liabilities, long-term debt. Let me call it long-term debt. So essentially you can use any of these formulas, it doesn't make any difference. But what you need to know is that PBIT is divided by capital employed. And this is one of the most important, I'm again repeating, a very important ratio. The return on capital employed measures how efficiently a company uses its capital to generate profits. Now let me go to Excel. I want to show you something here on Excel sheet. The problem with your capital employed thing, do you see Excel?
Yes, sir.
Okay. So let's suppose that in a particular year, 2008, and then you can do it for 2009, let's suppose. You've got here your PBIT, which is 10,000, and you have here your capital employed. Capital employed means total assets minus current liabilities. Capital employed is 100,000, and of course your ROCE is this divided by this, which is 10%. Okay. Now what happens?
Sorry, you can see the Excel that we cannot. So Excel said that we cannot see the.
Okay. Can you see now?
Yes, sir.
So PBIT is 10,000. Capital employed is 100,000. So your ROCE is 10%. Now this is what I'm going to explain. This is a very common scenario in exam, and you have to understand it so that you explain it. Now let's suppose that this company did not purchase any non-current assets, or it did not sell any non-current assets. So its asset base remains same. So what happens that in next year maybe it again made a profit of $10,000, the same PBIT, but because there is some depreciation of 20%, so it did not add any new assets, but old assets they must be depreciated. So when old assets are depreciating, your total assets are coming down and your capital employed is decreasing. So your capital employed will become 80,000. So now when you see your ROCE, it looks like that ROCE has improved, ROCE has gone up. And you would say that, wow, we are doing very good. Actually, you did not do anything special. Your profit was same as before. The only reason why it increased is that your assets just depreciated. You just got a depreciated asset. In next year, it will go further. So what I'm just trying to explain you that sometimes when you calculate ROCE, you need to pay attention to any depreciation, impairment, or revaluations. That let's suppose that your profit is same, but you made a revaluation on asset. And when you made a revaluation, so it becomes 125,000. And suddenly you will see that ROCE has gone down. So you should understand that it's not about your operating capacity or capability. Your operational activities are same. The effect for the change in ROCE is probably because of revaluation. Do you understand? So now ROCE, it looks very less, it looks little. So now you should think about that if my asset is really so much valuable, then why I'm earning only this money? I don't like this. So maybe I can sell either I should increase my, so let's suppose it is a rented business. Let's suppose it's a property and the property has increased in value. When property will increase in value, your ROCE will go down. And now you've got two options. Either you increase the rent, and if rent you cannot increase, then probably you may think of selling the asset and investing this large amount in some other business, which gives a better return. So in any case, you should understand that sometimes ROCE is not about PBIT, it is just because of some revaluations or depreciation. Now, there is another possibility as well. Another scenario is that let's suppose that you purchase some asset. You purchased a new asset in December. So you purchase a new asset, it immediately is added into the balance sheet, it goes to the balance sheet, but this asset you have not used enough period in this year to increase your profit. You have not gained any benefit from the asset. So the gain from the use of asset, it has not yet received. It is not reflected in income statement. So profit is same. Next year, when you will use this asset for 12 months period, maybe your PBIT will be more. But as for this year is concerned, the purchase has impacted the balance sheet, but the asset is not bringing any value to the income statement, and therefore it looks down. So what I'm just trying to explain you that when you will do your PBIT thing, your ROCE, you have to be careful that why this is going up or going down. So significant change may be due to new assets acquired during the year, which are not yet running at capacity, or maybe is assets aging, which means depreciating assets or revaluations. Then you calculate return on equity, ROE. So again, the formula is PBIT divided by total equity into 100. So in ROCE, you calculate PBIT over debt plus equity, both. But in return on equity, you use the same PBIT, but divide it with only equity, not the debt. And the return on equity focuses on the return for the ordinary shareholders. Significant change may be due to the reasons previously stated for changes in ROCE and considerations of changes in interest paid and getting debt equity levels. So this is gone. So these are your, then you have asset turnover ratio. In asset turnover ratio, you talk about that how much you are getting the revenue based on your assets. So this is the relationship between your sales and your assets. You've got net asset sale, total asset less current liability. So you get your capital employed and you have the revenue. So how many times you are generating sales using your assets? So asset turnover ratio. This ratio measures the efficiency of the use of net assets in generating revenue. Ideally, the ratio should be increasing, but you need to be careful when making assessments based on this ratio due to timing issues. Timing issues means if you are purchasing asset at the end of the year, so asset will be added here, but revenue will not be increased. So it tells us that how efficiently we are using our asset to generate revenue. Then you have liquidity, gearing, and working capital. So this is the first ratio, very important ratio, current ratio, which means current assets divided by current liabilities, which means that current assets is like inventories, receivable, advances, and cash divided by payables, accruals, and bank overdraft. So it tells you that this is the cash you are going to receive within 1 year, and this is the cash you have to pay within 1 year. Ideally, this ratio should be close to 2. Like your current assets should be 2 times your current liabilities. But sometimes you have to be careful with this ratio, that because within current assets you include 2 things. You include your inventories and you include your receivables. So we say that we are going to receive $100,000 in next 1 year, but this 100,000 include inventories. What if you are not able to sell your inventories? What if your receivables, they include some bad customers? You have some long outstanding receivables. So you have to be careful on that. And so what we say that generally, this ratio is 1.5 to 2.5 in between. 2 is good, but again, it depends on your industry. This is something which is a very generalized thing, but you have to see that in different industries it may differ. Okay. Then you have your quick ratio. So quick ratio and this current ratio, they are quite similar. The only difference is that in current ratio you use current assets, and in quick ratio you use quick assets. Quick assets means current assets minus inventories. So you say that what if I will not be able to sell my inventories? What if I don't sell my inventories? Then what happens? Will I still be able to pay my liabilities or not? Can I pay my liabilities without selling my inventories? Because I'm not sure if they will be sold or not. So this is a quick ratio thing. So quick ratio usually is lower than current ratio. For example, if your current ratio is something like 1.8 to 1, which means that current assets are 80% more than liabilities, your quick ratio probably would be 1.25 to 1. So it has generally a lower value than the current ratio. Okay, it means that this is similar to the current ratio, except that it omits the inventories from current assets. This is because inventories are the least liquid current assets that the company has, and because we may or may not be able to sell them. A ratio of less than 1 to 1 could indicate that the company would have difficulty paying its debt as they fall due. Then you have inventory turnover period. So inventory turnover period, you use inventories divided by cost of sale. Sometimes you can use average inventories, like opening inventory plus closing inventory divided by 2. This ratio measures the number of days inventories are held on average by the company. So it tells you the shelf life of days held by business within your warehouse. So how many days the goods remain in your business before you sell them? So you bring the goods, do you keep them for 1 month and then sell them? Or do you keep for 1 week and then sell them? Or probably you sell the goods the same day? So it gives you, the answer always is in number of days. Answer would be like 20 days, for example. So 20 days means the goods remain with you for 20 days, or probably the answer is 30 days because you are multiplying with number of days. So answer to this ratio is always in terms of number of days. And then you have receivable collection period. It is also in terms of days. So it tells you that how, by the way, in inventory turnover period, a significant change may be due to a change in the type of inventory held. Maybe you are adding, for example, your inventory days are increasing. Before 20, now 25. So inventory days have increased. Maybe you are adding some slow moving inventories in your business. Those inventories which are sold a little bit late. Or maybe improved or worsened inventory control. Your inventory control is not good. You are ordering more than what you need, so they remain in your stock. And changes in the popularity of certain inventory items. Maybe some inventory items, their sale go down, and therefore they are not sold very quickly. So you need to find out the reasons why your inventory days are increasing or decreasing, and these could be the reasons. Similarly, you have receivable collection period days. So trade receivables divided by revenue. Again, you can use it as average receivable, opening receivable plus closing receivable divided by revenue to 365. Answer would be in number of days, say 35 days. So if it is 35 days, it means that on average your customers, they pay you in 35 days. Your receivable collection period is 35 days. Now, or probably answer is 40 days. Let me make like this. Answer is 40 days. Let's suppose. So if answer comes 40 days, but you know that when you sell goods, your contract, it says 30 days. On your contract, you tell every customer that you will pay 30 days, but end of the year, you find out it is 40 days. So it means that there is something wrong. What could be wrong? Either your customers are not paying in time on average, or maybe there is one big significant customer who has made a lot of delay, and that's why this thing has increased. Or maybe your accounting department is not working good. They are not issuing invoices in time, or they are not providing sufficient payment documents to customers. Because when I go to my customers and I say, why do you people pay so late? And they would say, we don't have any problem with payment. Your accountants do not send us the proper documentation for making payment. Tell your accountants to provide us the documentation, we will make payment. So you need to identify where is the problem. So significant change may be due to increase, decrease in credit terms offered to customers, a change in the mix between cash and credit transactions, because now you are selling more goods on credit, or better worse, credit control. Credit control means like the receivable accountant and talking to the customer, etc. Then you have liquidity, gearing, and working capital. So it is now your payable days, just like here you calculated your receivable collection period. Now you have to do your payable payment days. Payable payment days means that on average, how many days are you paying to your suppliers? So trade payables divided by purchases into 365. Sorry?
No, sorry, sir.
Okay. So this ratio means the time it takes the company to settle its payables, trade balances. So trade payable provide the company with a valuable source of short-term finance, but delaying payment for too long a period of time can cause operational problems as suppliers may stop providing goods and services until payment is received. So there's a possibility of a bad relationship or a bad reputation with your suppliers. And why it happens? It happens because either there is a change in the supply in the credit terms, or maybe increase, decrease the cash the company has available to make payment. Maybe you don't have sufficient cash, or maybe bad management of your payable ledger. Okay, this payable day ratio, you have to be very, very, very careful. I always tell you that you can, you can tolerate. If your customers do not pay in time, no problem, you can wait. But please never make a delay to your suppliers. This is something I would say 5-star importance. One of the most important thing is making payment to your suppliers and to your employees in time. When you don't make payment to your suppliers and to your employees in time, this business will never grow. Because when you don't make payment to employees, your good employees will leave you. Anyone who can find a job, and usually the smart people can find a job. So smart people, they will leave you immediately. And similarly, when you cannot make payment to your suppliers, so the good suppliers, which have good quality products, they will also leave you because their goods are purchased by everyone. So you will not have good quality raw materials and good quality supplies in time, or probably suppliers will start asking more, they will charge you more. And you will also lose on your employees, and there will be a lot of demotivation within the company when you are not making payment to suppliers, because everybody is upset. Because sales department will say, I have an order to deliver to customer, but procurement will say that supplier is not giving raw material, what do I do? And the supplier is calling the accounting department, where is my payment? So accounting department is upset that supplier is calling every day. Sales department is upset that customer is calling every day, where is the delivery? And procurement is also upset because supplier is refusing him to supply goods. So it can have very devastating effects, very devastating effect on your business. Okay, so this is how we do. We buy inventories, we sell inventories, and we receive cash. So here you have inventory days. So this is the inventory, it remains within your warehouse. When you sell the goods, and selling the goods and before receiving cash, it is called receivable days. And here you've got working capital. So this is called your cash cycle. So your cash cycle, actually, it includes what? Let me write down in a very simple word instead of this diagram. I would say that it is. So what is happening? You pay cash and you purchased inventory and inventory days. Inventory days means that it remains in your raw material warehouse. Then you have plus production days. Then you have plus finished good warehouse. It remains 10 days in finished good warehouse. Then you have receivable days when your customer is paying you, and minus the payable days. What does that mean? I buy inventories, so my inventory days are 10. The goods, raw materials, they remain in inventory for 10 days. Then I send them to production. In 5 days, I finish the production. Then the goods, they remain in my finished good warehouse for another 10 days before they are sold. Then I sell to my customer, and the customer pays in 30 days. So this makes me, 30, 40, 50, 55 days. But out of 55 days, I get 20 days credit from my supplier. This is my payable days. So in 35 days, this is called my cash operating cycle. My cash operating cycle, which means that we have to invest cash for 35 days because our total demand is 55 days. Total completion cycle is 55 days, but out of 55 days, 20 days credit we receive from our supplier. So 35 days, we have to finance our operations. So you need to finance your activities on 35 days. That is called cash operating cycle. And businesses, they try to decrease cash operating cycle. We have to reduce the cash operating cycle. So this is some example. Then you do liquidity or gearing ratios. So it's very simple. One is your debt over equity into 100. You call it debt equity ratio. So how much debt do you have in the balance sheet and how much is equity? And of course, we talk about interest bearing debt, which means loans. We don't talk about payables or receivables from suppliers. So this ratio measures a company's gearing and leverage is the same word, and is concerned with the long-term financial stability of the company. It looks at how much debt the company has in relation to its equity funding and gives a percentage for gearing. Interest-bearing debt describes a long-term debt on which a company is required to pay interest. So a significant change means an issue of share during the year. So if you issue new shares, your equity will become more and debt equity ratio will go down. Or repayment or taking out of new debt financing. Or probably you have taken out some debt or you have returned back some debt. So this ratio may change. So you can have this ratio 30-40, like 40-60 and etc. Then you have debt over not equity. Here you say debt to equity. This you say debt to debt plus equity. So you add both of them, debt over debt plus equity ratio. So again, interest-bearing debt divided by interest-bearing debt plus equity. So this ratio is a simply different method used to calculate gearing. It's the same thing, just in one case you say debt over equity, in another you say debt over debt plus equity. I would go for this more. If they ask me calculate gearing, I would use this one. This is my first choice in calculate gearing, okay? So then you have interest cover ratio. Interest cover ratio tells you that how much are your profits in relation to your interest expense. So what is your profit? Your profit is $10,000 and your interest is $1,000. So ratio is 10. So it means that your profit, your earnings are 10 times more than your interest payments. What does that mean? It means that this ratio considers the number of times the company could pay its interest payments using its profit from operations. A company should always ensure that it does not have so much debt finance that it risks not being able to settle the debt as it falls due. Significant change may be due to factors which have a significant impact on profit. For example, if your PBIT is going down, if your operational profit is going down, this ratio will go down, which is a bad sign. Or maybe you have taken the debt, so interest is increasing. If interest is increasing, again the ratio goes down. It's a bad sign. Usually you should have 7 to 10. A very comfortable ratio here would be between 7 to 10 times. So your interest, your earnings should be 7 to 10 times more than your interest. If it falls below 7%, it means that you are entering the risk zone. Okay, so shareholder investment ratios you have. So the first one is which you call dividend yield ratio. Dividend yield ratio is dividend per share divided by market price. Mid market price means average price of the share into 100. So how much dividend is given? So you know that dividend is different from earning. Earning means what you are earning, and dividend means what you are actually receiving. Because it is possible that your EPS earning per share is $5, but dividend is just $1 because the management has given out dividend only 20%. So this ratio is about what we receive. The dividend yield ratio expresses the dividend per share as percentage of the current market price of the share and provides an indication of the return the investment is giving relative to the company's share price. So dividend per share, it's not really very important, by the way, because EPS is more important. Because sometimes a business may not be giving any dividend. You don't give dividend, you give zero this year. It does not mean that you did not earn. It's just that you did not give. Then you have dividend cover ratio. So dividend cover ratio is EPS divided by dividend per share. So how much were your earnings? So let's say that our earnings were $5, and how much was the dividend? We gave dividend only $1. So it means that answer is 5, which means that EPS or earnings are 5 times more than your dividends. So it just gives you the portion of profit for the year that is available for distribution to shareholders. And that has been paid out. So what you earned and what you paid. This is what you earned, this is what you paid. For example, a dividend cover of 2 times would indicate that the company has paid 50% of its profits as dividends and retained 50% in the business to help finance future operations. And then you have got another type of ratio, which is called price earning ratio. Very important. This is called PE ratio. So PE ratio is market price of the share divided by EPS. So what is the share price in the market? For example, you've got a share which has the market price of the share is say 20, and the dividend it is giving is 2. EPS is 2. So your PE ratio will be 10. What does this tell us? It tells us that if an investor buys today a share for $20, we ignore time value of money. And if I purchase a share of $20, if I invest $20 today, I will start getting $2 in the next years. It will take me 10 years to collect my investment back. When this ratio is high, it shows that the share is trusted in the market. People are paying more money. They are willing to give more value to the share. If this PE ratio is going down, it means that you are losing the trust of the market. Like in year 1, you had 20 here and you had 2 here, and your PE ratio was 10. But next year your dividend is again 2, but share price comes down to 18. It means that people are willing to pay you only 9 times of the earnings. So it shows a decreasing level of trust by the market. But of course, a too high PE ratio also has risk. You don't want to have it too high as well. So a PE ratio, a high PE ratio indicates strong shareholder confidence in the company and its future because the market has valued its share at a high price relative to the EPS paid by the company. So significant change may be due to a change in the level of profits earned by the company or a change in value shareholders perceive in the company. So all of these ratios. Now what we need to do here is, let me stop it here. So actually we are done.